Student loans are a pain to pay back. And whether you're just starting on your student loan debt payoff or are in it for a few years, I want you to stop what you're doing and I want you to pull some of your student loan bills. Look at your interest rate. That interest rate could be costing you thousands of dollars. Welcome to Sisters for Financial Independence. My name is Catherine Agapjan. Here at Sisters for Fi, we cover money topics to help you get better with your money so that you have more to live, save, give, and pass on to the next generation. Today's topic is all about student loan refinancing. If you are feeling the burden of high interest rates, confusing payment plans, or just want to save yourself thousands of money and finally get rid of your student loans, then you are in the right place. I know what you're thinking. Refinancing, is it even for me? Is it complicated? Will it really save me money? By the end of this video, you will have a clear understanding of how to refinance your student loans to see if it's right for you. And you will also have a step-by-step guide so you understand the full process of student loan refinancing. Like most of the videos here at Sisters for Fi, this will also be a step-by-step explainer video. So it's going to be a little long. I'm going to encourage you to check the timestamps for any type of specific information you're looking for. And don't forget that at the end, there's going to be some rapid fire FAQs to help you answer all of your questions about student loans. We're going to break it down, everything from eligibility requirements as well as where to find the best rates in 2025 and beyond. So let's start with the basics. What exactly is student loan refinancing? Well, simply put, it's taking on a new loan from a private lender to pay off your old student loans. So basically, you would apply to certain lenders that focus on student loan refinancing, and when you get approved, that new lender will pay off your existing student loan and all of your new payments will go to the new lender. The goal with student loan refinancing is to find a lower interest rate. A lower interest rate can significantly save you money and speed up your payment process. Refinancing can also simplify your finances as it can also combine all of your loans into one, and now you have one large loan that you will pay off. The reality with student loans is that the standard payback window is 10 years. That is a long time to be paying for something you did in your early 20s. When I graduated college, I had around $20,000 of student loans, and I was super determined to get everything paid off by the time I hit 30. My sisters here at Sisters for Fi also wanted to get that goal in place. If you are tackling thousands of student loan debt, that timeline may not be reasonable. But if you refinance your loans, knock it down and get a lower interest rate, that can potentially save you a lot of money and get you paying your loans that much faster. I don't want student loans hanging over your head for 10, 15, 20 years. I want to free up your mental space. I want to free up your money so that you have more money to live today, save, or invest for the future. Refinancing student loans is not for everyone. There are a few groups of people that this will be right for. So who should consider refinancing their loans? The first group of people that should consider refinancing their student loans are those with a good job, a steady income, and a good credit score. Lenders want good borrowers. Lenders still want to get paid, so they are going to be looking for people who can pay back their loans. Now, for majority of these lenders, they will be looking for someone with steady income, with a good job, and with someone with a credit score of over 600. This will confirm to the lender that you are a good borrower and that you will pay things on time. And for people who have these criteria, this will mean that you can likely get a lower interest rate and save money and time there. The second group of people that might want to consider refinancing their student loans are those who want to get a lower interest rate, especially if your interest rates are in the double digits. Having an interest rate of 12% on a few $1,000s of student loans is going to take time to pay back. But if you can drop it to single digits like 8%, 7%, that can significantly speed up your payment time. And it doesn't matter whether you have federal or private student loans. If your goal is to save money, applying for student loan refinancing to get you lower interest rates can help you there. The third group of people that might want to consider refinancing their loans are those who want to simplify their payments. Now, normally when you receive your student loans, they get dispersed at different time, maybe by semester, by year, and you have a lot of these different loans. And that can be hard to track. What you can do is do a refinance, and what they will do is consolidate all of your loans into one. So now you will be looking at one larger loan and one payment going to one place instead of managing multiple loans, which can get confusing and might lead to missed or late payments. So if you want to simplify all of your student loans into one large loan payment, you might want to consider refinancing your loans, as it will consolidate everything into one and get you a lower interest rate. The fourth group of people that might consider student loan refinancing are those who are okay to lose federal benefits. Now, there's a difference between federal student loans and private student loans. When you refinance federal student loans, you will refinance with a private lender. So you are going to pay off the federal government, pay off your loans with them, and then take on a new loan with the private lender. When you refinance, you will lose federal benefits. These will include income-driven repayment plans, your public service forgiveness plans, as well as deferment or forbearance. So you have to understand what you will lose if you are going to refinance. Is the trade-off for a lower interest rate worth it for you? Now, during the time of COVID for a few years, the federal government paused payments on federal student loans. So you had the opportunity to pay down your loans without accruing interest, or you had the opportunity to use your money for more important things. So you want to consider if losing federal benefits is worth it for you versus getting that lower interest rates. So as the years go on, as you enter more financial stability, you're earning more income, it's good to revisit. Now might be the time to lose your federal student loan benefits in favor of a lower interest rate so you can pay off your student loans faster. I want to address something big, and that's the One Big Beautiful Bill Act that was signed into law in July 2025. This has significantly changed the student loan landscape with major consequences for federal loan refinancing. The OBBB eliminates popular income-driven repayment plans for most new loans and curtails repayment options. These policies will likely push more borrowers to refinance, since fewer will qualify for these federal benefits. Ultimately, the decision to refinance is up to you, but it's important to consider how this One Big Beautiful Bill Act impacts you and your future. If you fit any of those groups of people, let's look at some of the key benefits of refinancing. The first one is lower interest rates. When you lower interest rates on your debt, it means you have the potential to save money as well as pay your debt off faster, because a lot of your dollars is now going to principal instead of interest. And this can be a lifesaver, and this can mean you get out of student loan debt that much faster. The second benefit is reduced monthly payments. A lower interest rate or a longer loan term means your monthly payments will be reduced. This will free up cash on a monthly basis, and it can reduce stress and allow you to meet other goals. The third benefit is that it can save you money over the life of your loan. Less interest means less money needs to be paid back, and that means more money back in your pocket. The fourth benefit is simplified payments. When you go to refinance and you combine all of your loans together, it means you will have one larger loan and one payment with one lender. This makes things easier. It simplifies your finances. It also decreases the likelihood of you missing a payment, which dings your credit history and your credit score in the long run. The fifth benefit is a change in your loan term. When you go to refinance, you will have the option to set your loan terms, which means you can set the number of years you want to pay back that loan. A shorter term means you will be able to pay back your student loans much faster and save you money. But a longer term might mean you spend more money in the end, but you have lower monthly payments, which gives you a little bit more freedom on a monthly basis. Before you do anything with your student loans, I do want you to play around with the calculators out there, because I want you to see the difference in savings when it comes to a lower interest rate. I want to switch gears and walk you through a calculator so that you can see the impact of student loans, how much you'll save, as well as the impact on if you change your term horizon. That way you can understand what it means if you choose a shorter term versus a longer term. I'm using studentchoice.org's student loan refinance calculator, and I have entered two loans here. The first one is $20,000 at 12%, remaining payments of 60 months. That's 5 years. And the second loan is $10,000 at 10%, and that is also at 60 months remaining payment. Let's calculate to see what it looks like if we were to refinance. Now, for this scenario, it's using the rate of 4.24% APR. Now, depending on your credit score, depending on so many other factors, this might not be the rate that you get, but this will be the rate that we'll use for this calculation. And we're going to stick with the 5-year term. Now, if we were to refinance and get this low rate, which is lower than our current interest rates, that's a big plus. So current monthly payment estimated is around $657. If we refinance, it's now around $555. It's $101 less than you normally would have to pay for. And over time, you will be saving around $6,000 over the life of the loan. That is significant money. Now, this is where I want you to be careful when it comes to changing the terms of your loans. 5 years is a long time to be paying your loans. I get it. But if you do extend it to 10 years and your new monthly payment will drop down almost half of what you're normally paying. That could be great if you really need the funds, if there's a crunch in your budget on a monthly basis. So you have $342 back to your budget. But it will mean it will take you another 5 years of loans. That's 60 months of paying this amount. That is a long time, and that is a long time to be worrying about your debt. But also, you won't be saving as much. In total, you'll only be saving around $1,700 over the life of your loan versus the $6,000. So just be careful and play around with the numbers when it comes to the terms of your loans and what you want your monthly payment to be. If you are able to swing a higher monthly payment or keep even the same monthly payment, any extras will mean you will pay off your loans that much faster. So you'll be debt-free maybe a year or a few months earlier, and that could be a big deal. With all of that in mind, what else should you consider if you are going to proceed with student loan refinancing? Well, the first one is a big one, and it is losing federal loan benefits. I mentioned earlier that if you do have federal loan benefits and you refinance, it will be switched over to a private lender, meaning the private lender will pay off your federal student loans and you will have a new loan with a private lender. When this happens, your loans become private, so you do lose your federal benefits protection. That means no income-driven repayment plans, no public service forgiveness, no deferment, forbearance, or potential forgiveness that might happen for federal student loans. So you need to weigh the pros and cons with this to see if it's worth it for you. So the general consensus in this scenario is to leave your federal loans where they are and focus on your private student loans. Likely your federal student loans are at a lower rate, especially since Congress sets those, and your private loans are likely at a higher rate. So focus on your private student loans and see if you can refinance those and get those at a lower rate. You're going to tackle this from all sides. And if you can continue to have the federal benefits for your federal student loans, but get lower rates on your private loans, you can get these loans paid off faster. I will say that for some people, losing federal loan benefits can light that fire for them to really focus on paying off debt, getting that extra job, earning more money. So that might be something you want to consider if that kind of accountability works for you. The second thing you want to consider is impact on your credit score. There is going to be a temporary hit on your credit score, especially because the lender will have to pull a credit score and a credit report to make sure you are a good borrower. Now, this will be a temporary dip, but as you continue to pay your loans on time, your credit score and history should improve. Now, I also don't think you should worry so much about your credit score. Focus on paying your debt on time. Focus on getting rid of it completely. At this point, you shouldn't be taking on new debt anyways, so your credit score shouldn't matter as much. The third thing to consider is that there is no guarantee of a better rate. You might not qualify for a better rate than what you already have. But this should not dissuade you from trying again 6 to 12 months from now. As your financial situation improves, as you continue to pay your bills on time, it can change your credit history and improve your credit score, which means you will be seen as a good borrower and potentially an ideal candidate for a lower interest rate. It's also good to try again 6 to 12 months because the federal interest rates might have also dropped and it might be a favorable environment for lower rates. So if you do not get the lower interest rate, do not be discouraged. Try again in a few months when certain economic environments have changed. And the last thing that you want to consider are refinancing fees. Most reputable student loan refinancing companies do not have these fees, but you want to check the fine print anyways. That way you fully understand all of the costs associated with student loan refinance. We've covered a lot already. Give this video a like if you found it helpful and share it with a friend. See if there's someone else who can be your accountability buddy as you go through the student loan debt payoff journey. I also have some free resources for you to check out when it comes to your student loan refinancing. It does take effort to find the best rates, to find the best companies to work with. So there's a checklist that you can follow through so that you understand what you need to do, what you need to verify before you go through the process. This can help ensure that you are doing things correctly and you're not forgetting about certain steps. All right, now it's time for us to get into the nitty-gritty of how to refinance your student loans. I have broken down this process into a 5-step guide. The first one is that you are going to gather all of your loan details. You might have a bunch of paperwork with them on it. You might want to check your emails. You might want to go into studentaid.gov to pull them, or you pull up a credit history to find your private student loans. And you are going to list them with the lender, the balance, the interest rate, and the repayment terms, as well as window. How much time do you have left for some of these loans? As it can help inform you which of those loans will be the most important for you to refinance. It might be that you don't need to refinance all of your loans, just a small portion, maybe just the private ones with the higher rates. And it's just a good idea to have all of your loans in one place. You can use the template in the description so that you have a listing of all of the information you need for your student loans. The second thing is that you're going to need your credit score. Now you can go to annualcreditreport.com to pull a copy of your credit report. This will not give you the score, but you can see some of the loans you've taken out if you've forgotten about them. You can also see some things that might affect your credit score. You just want to have a look to make sure everything looks good. And then you are going to pull your credit score. Now, for most refinancing lenders, they will want a credit score of 600 or above. So if your credit score is not around this range, it might be time to work on your credit score first. That way you can get the best rates and best terms possible. If your credit score is not there yet, then you will probably need to spend the first few months improving your credit score by paying your bills on time, getting rid of other debt, and working to resolve some of your credit issues. Step 3 is probably the most important part. You are going to search and compare lender rates. Do not go with just one lender. Look for others and compare their rates and see if you can pitch them against each other. Don't go with just the first lender you see or the lender that you see most advertised on the internet. If they have the money to do a lot of marketing, they might not have a lot of money to adjust interest rates. So just be aware of that. You want to look for a lender that's specialized in student loan refinancing. You want a lender with good reviews, with good customer service, and with good rates. You do have to apply and send your information to get the rates back. So this is why it's good to be prepared. It's good to understand what your credit score is. It's good to understand how much of your loans you want to refinance and what the best rates you want to go for. There are a ton of student loan refinancing companies out there. So you want to look for one that fits your needs. Here's a short list of companies you can check out. It's Earnest, you have SoFi, Splash, Laurel Road, Elfi, Credible, Lenki, Citizens. And from what I have been reading, there are 3 companies that tend to dominate the student loan refinancing market, and that's Earnest, SoFi, or Laurel Road. So if you are not able to go through all of these student loan refinancing companies, start with these first 3 and see what you can get when it comes to rates. Many of these lenders will have a pre-qualification process, so you can submit some of your information and they will do a soft pull on your credit report. This is the best way to see what the potential rates are for your student loan refinancing. Step 4 is to choose your loan offer and apply. When you submit your pre-qualification, they will give you a few options as far as terms of your loans and the interest rate. You will choose the one that works for you. Remember, you are going to do this across the board for multiple companies. So find the one that works for you and figure out the right term that works for you. A shorter term at a lower interest rate means your monthly payments will be a little bit higher, but you can get out of that much faster. If you are going to extend your loan term, you will be paying more over those years, but your monthly payment might be lower. So think about your needs today as well as in the future. When you do get your loan terms back, you will also have the option to do a fixed rate or a variable rate. With a fixed rate, you get the same rate for the life of the loan. With a variable rate loan, your rate will change based on the market. So it could go up or down. Fixed rate is recommended just for stability, and you also have the opportunity to refinance later on too. Be careful with choosing a variable rate in case there is a potential that the rates might go up later on, which means you won't be saving any money then. Then you are going to complete your application. You will need to submit proof of income, and that might include pay stubs or a W-2 form. You will need to submit proof of your student loans to those new lenders so that they can verify the amount they need to pay off. They can verify that those loans exist. So make sure you also have those documents handy so this process is smoother for you. And the last step is to finalize and start making payments to your new lender. Once your application is approved, your new lender will pay off your old student loans. But I do want you to make sure you log on to your old accounts and verify that it is at zero balance, that everything has been paid for and you have documentation for it. And then with your new lender, make sure you start setting up AutoPay so that it automatically deducts your payments to them. For many lenders, they will offer you a rate deduction if you also set up automated payments. And again, this can help you save money in the long run and ensures you never miss a payment. Let's hit some frequently asked questions and important considerations. Can you refinance both federal and private student loans? Answer is yes, you can combine them into one new private loan. Just remember the federal benefits point. What if I have bad credit? Can I still refinance student loans? You can, but it'll likely be tougher, but not impossible. You might need a co-signer. A co-signer with a good credit can help you qualify for a better rate, and it might be that you wait a few more months until you improve your credit score to apply. When is the best time to refinance your student loans? Ideally, when interest rates are low and your income and credit score are strong. Don't wait until you are struggling. How many times can you refinance student loans? As many times as you want, technically. If your credit improves or rates drop further, you can always refinance again. What documents do I need for student loan refinancing? Typically, proof of income like pay stubs, W-2 or tax returns, a government ID, and statements from your current student loans. What if I get denied? Likely it's due to a low credit score or a high debt to income ratio. In this case, work to improve your credit score by paying all of your bills on time and reducing other debt. And of course, work to increase your income so that debt to income ratio also improves. What are the current student loan refinancing interest rates? Your interest rate on a refinanced student loan depends on your credit profile, income, and debt to income ratio, and so many other factors. This table shows approximately the lowest fixed rates available in 2025 for the best qualified borrowers. You should not necessarily expect to get this rate as low as what's listed, but it's a reflection of the market. And if you don't get these rates, consider refinancing 6 to 12 months as the environment changes. Student loan refinancing is just one of multiple approaches you should be taking to get savvier with money. My final piece of advice, don't be afraid to explore your options. Student loans are tough. They have a way of sticking around if you are not careful and focused on paying them off. Even a small percentage point difference in your interest rate can mean big money today as well as in the future. Use online calculators. Play around with them so that you see the potential savings and make an informed decision. You don't have to refinance all of your student loans at once, but a small portion might be helpful. If you are ready to take control of your student loan debt, start by checking your credit score and then getting some pre-qualified rates from a few different lenders. There's a lot of resources in the description so that you can get started. And if this video has helped you understand how to refinance student loans better, let me know in the comments below. Have you refinanced before? Share your experience with others, whether it's good or bad. You can help someone else. And And of course, if you found this video helpful, give it a thumbs up and share it with a friend. And subscribe to Sisters for Fi for more money content. For more tips to help you tackle your student loans, I'm going to recommend this playlist. If you are also managing credit card debt, I'm going to recommend this playlist. Thank you so much for tuning in to Sisters for Financial Independence. I will see you in the next video. Bye.